Good morning. We welcome you all to our annual discussion forum, the Union Budget 26-27, an in-depth analysis. We are doing this program every year, and this year we are doing with PwC. I request Mr. Navarun Sen, Vice President, the Bengal Chamber of Commerce and Industry, and Chief Operating Officer, Century Plywoods India Limited, to please be on the dais. I request Mr. Dwarkanath E.N., Partner, Price Waterhouse and Company, also to please be on the dais. I request our Vice President, Mr. Nabarun Sen, to please deliver the opening remarks and take the session forward.
Thank you, Sharwani. Good morning. And on behalf of the Bengal Chamber of Commerce and Industries and in partnership with PwC, I welcome you all to this session of the post-budget in-depth analysis program. We've been having this program for the last many years, and it's always been a tremendous response, a lot of intense discussion by all the participants. So I hope to see a very nice discussion today as well. So as you are aware, the current industry, the world is facing, headwinds in terms of trade headwinds, disrupted trade protectionism, weaponizing of tariffs and currencies, and the situation is pretty volatile. However, the Union Budget of 26-27 presented by the Honorable Finance Minister reflects a well-calibrated approach that balances growth, and I would specify medium to long-term growth imperatives along with fiscal consolidation. So the budget sustains a strong push on capital expenditure while keeping the fiscal deficit firmly within the 4.3% of the GDP target. And I think this has been a really credible work done over the last couple of years, and we've continued to maintain the fiscal deficit. Now, with the record 12.2 lakh crore allocated to public capex, this budget reinforces infrastructure as the cornerstone of our growth engine. It aims to strengthen shipping, logistics, mining, and critical minerals through new national waterways, rare earth corridors, a 10,000 crore container manufacture scheme, and many others to build our global competitiveness. So at a macro level, my own understanding is that the budget continues on the work done over the last 2 years budget and focuses on the long term, both in terms of manufacturing and services. Is both. Significantly, the budget, this particular budget, and that's what I was just discussing with Mr. Dwarkanath, is that the budget eschews, big headlines or rhetoric. It's a very hard-working budget. And it is more focused on core building blocks, namely, and firstly, public investment-led growth, manufacturing and technology sovereignty, fiscal consolidation and with credibility, medium-term competitiveness rather than short-term relief. A message of the budget is that India wants to build and not just consume. And therefore, the key thrusts are on high-speed rail corridors, logistics and freight infrastructure, semiconductor mission 2.0, biopharma, textiles, and importantly, SME cluster revival, particularly in some of the legacy industries, for example, the sports manufacturing industry. You see, all these sectors lie in those areas where either we have competitive strength or it has a high level of job creating intensiveness. And in all cases, either it is export focused or strategically important to us. Okay, a high-powered committee has been now mobilized to propel India towards a 10% global market share of the world services market by 2047. The budget reimagines the service sector as a premier engine of growth, jobs, and exports. By sharpening the strategic focus, this initiative seeks to cement India's stature as a preeminent global services hub and redefine its economic trajectory over the next 25 years. One interesting aspect of this budget, while it's always been there, but it has been articulated, that in the 2026 Union Budget, Finance Minister highlighted what we call the orange economy. That is creative and cultural industries, activities where value comes from ideas, artistic expression, cultural capital rather than only physical goods. And this has been looked at as one of the new growth engines, especially for job creation and innovation. In this regard, the government will support the Indian Institute of Creative Technologies, Bombay, to set up what we call the AVGC Content Creator Labs. It's animation, visual effects, gaming, and comics. And these labs will be set up across 15,000 schools and 500 colleges across the country. And this sector alone has a projected requirement of more than 2 million professionals by 2030. Continuing the skill and employment that underpins the budget's long-term vision, the target upgrades to allied health institutions. In fact, there's a second NIMHANS being proposed for Ranchi. Large-scale training of healthcare support staff and caregivers, particularly geriatric caregivers, and the 10,000 crore Biopharma Shakti initiative over 5 years aims to catalyze research, manufacturing, and high-quality job creation. Complementing this is the announcement of the 10,000 crore SME Growth Fund to provide equity support and nurture what we call the future champion enterprises out of the SME sector, who are globally competitive and who can scale up fast. Though it's only 500 crores for the next year, but over the next few years, 10,000 crores are going to come in as support for the SME sector. Now, talking about the center-state relationships, the adoption of the 16th Finance Commission Council, the center has announced a rupees 1.5 lakh crore grant allocation to the states. This reaffirms a resolute commitment to financial decentralization and balanced regional prosperity. It recognizes states as the primary architect of their own growth and progress, and not just implementers of the central policies and programs. The budget continues to invest in building West Bengal's infrastructure and logistics landscape, anchoring regional trade through a high-speed rail network from Siliguri to Varanasi, and a new dedicated freight corridor connecting Dankuni to Surat. By positioning Durgapur as the vital industrial node for the entire Northeast, these strategic arteries will weave the state deeper into the national economic fabric, catalyzing a new era of seamless connectivity. The Union Budget of 2026-27 is a bridge to what we call the Viksit Bharat 2047. It continues to clear the compliance thicket and lays the high-tech track for India. India that is no longer just going to participate in the global race, but also will start defining some of its rules. So this is the vision. And now I would like to welcome our experts from PwC and our other esteemed panelists who are with us today to share their insightful perspective of the Union Budget and provide a detailed presentation in the due sessions ahead. So thank you very much. And I really throw the session open for further discussion.
Thank you, Mr. Sen, and thank you to the Bengal Chamber of Commerce for inviting us to participate along with you in the discussions on the 2026-27 Union Budget, which was presented yesterday. As we all know, this was Mrs. Sitharaman's 9th consecutive budget, and she stands on the cusp of a record. But the budget this year was presented in a very different backdrop than what it has been in the past. As the economic survey, which was released a couple of days back, said, India is a beacon in an otherwise dark global economy. There is a clear recognition, both in India as well as globally, that the rate at which our country has been able to grow and overcome a lot of the headwinds that have impacted the rest of the global economies has set it apart from most of the major economies in the world. The real GDP growth was pegged at 7.4%, continuing to be extremely impressive, above 7% mark continuously. Private final consumption reached 61.5% of GDP, which is the highest since 2012, which essentially shows that there is more money in the hands of households to spend, and which in a sense is also reflective of the fact that inflation or headline inflation rate has broadly been in check over the last year or so. The financial sector and the monetary sectors have continued to show extremely strong performance backed by sound fundamentals. The current account deficit remained at moderate levels. The services share in GDP rose to 53.6% in H1, which is a record high. And India is now the seventh largest exporter of services in the world. These were some of the financial data and economic parameters based on which the finance minister was asked to present the budget yesterday. There were also some other events globally. I think some of us have made it a habit of watching the US president's updates on Twitter. And the impact of the tariffs that the US government has been imposing on the whole world, including India, was something that would have a bearing on our policies. The India-EU FTA, which was touted as the mother of all deals and negotiated and will come into effect shortly, and was announced by the government a few days back. And the GST 2.0 reforms, which turned out to be a Deepavali gift for many of us, were some of the other areas which the government had worked on over the last year or so to ease the economy and to spur growth within the economy. And two other very significant events which we should not ignore, or two other very significant developments. One, the new labor code, which the government introduced after many years of trying to pass it through as legislation across the country. The consolidation of 27 different labor codes, I think, was phenomenal as an achievement. And the impact of artificial intelligence and the fact that today, while for several years now, India is said to have a demographic dividend in terms of the youngsters in the population, that demographic dividend was not being translated into productivity, and it was worsened by the fact that artificial intelligence is threatening to take away the jobs. So this is the overall backdrop upon which the finance minister presented her budget decisions, her budget policy. From a policy standpoint, she stated that the government had 3 kartavyas, and all very nice to hear. She said the government was committed to accelerating and sustaining economic growth. They had to fulfill people's aspirations, and that every family, sector, and region should have access to resources and to opportunity, which means not only should there be growth, but that growth should be equitable and that growth must be participative. In order to do that, she said that the government had announced over 350 reforms in the course of the last year. From a budget standpoint, scaling manufacturing in 7 sectors, rejuvenating legacy industries, championing MSMEs, which continues to be a recognition on the part of the government that MSMEs are really driving the growth of this economy, continuing to develop infrastructure, energy security, and creating of city economic regions were the pillars on which this budget was laid out. From an industry standpoint, significant investment in biopharma, semiconductors, rare earths, sports goods, textiles, and electronics. These are the major industries that the finance minister placed thrust on. Of course, there is a lot of investment also in infrastructure as well as in defense. But these are the primary industries which receive budgetary allocations from the government. From an MSME standpoint, the creation of a 10,000 crore SME growth fund is something which is very welcome. In addition, there is a proposal for liquidity support to MSMEs, and interestingly, a recognition of the requirement for professional support for MSMEs by partnering with the ICAI, ICSI, and other professional institutions to ensure that professional support which is relevant for MSMEs is available to MSMEs on a real-time basis. Tier 2 and Tier 3 cities will probably be the biggest beneficiaries of infrastructure, which is a good indication that we're moving away from just continuing to develop cities like Bangalore and Hyderabad, etc., to Tier 2 and Tier 3 cities. The creation of freight corridors with an emphasis in this area on Paradeep and Kalinga and the connection to those ports. Ship repair for inland waterways in Varanasi and Patna will again benefit these particular industries. As I spoke earlier, with the impact of artificial intelligence now slowly becoming evident, the finance minister spent a good amount of time talking about skilling for the future, which is an absolute necessary. She identified certain industries where skills could be created such that to a certain degree, the fact that artificial intelligence may take away jobs is controlled. The industries include gaming, video games, etc., and audio visuals. There's an Indian design industry which is being created in the eastern region, and an emphasis on the design industry. Tourism and the training of 10,000 guides in tourism, again a recognition of the importance of this industry. Sports and sports product, and fisheries. In the northeastern region, of course, the development of Buddhism, the Buddhism tourist trails in the northeastern states, and the integrated East Coast corridor. Overall, the aspiration, while the fiscal deficit was controlled at 4.4% of GDP, the target for next year has been set at 4.3, which again displays significant fiscal prudence on the part of the government, and an aspiration for the first time of India having 10% of the global services market. So after a long time, the focus of the government seems to have shifted from manufacturing again back to services. From a tax standpoint, while my partners will talk in depth about the direct and indirect tax proposals, just from a summary, there is a new Income Tax Act which will come into effect from the 1st of April. There is a focus on clarity and foreign investment, specifically with regard to data centers, transfer pricing policies, toll manufacturing, which is important, as well as tax holidays for companies set up in the GIFT City or the International Financial Services Center in Gujarat. There are also some retrospective amendments which annul favorable court decisions to taxpayers. My colleagues will talk about it in depth, but they do have a significant impact. Some changes to the MAT provisions with regard to MAT credit, which will again have a significant impact to industry. Changes to buyback, which brings it back in line to the provisions that they were earlier, with some tweaks in how it is taxed and the tax rate. The integration of ICDS and INDAS in a committee formed for that purpose. And a very interesting and a very positive change where taxpayers now will only have to deposit 10% of the demand before proceeding to appeal, and that amount has been reduced from 20%, which with also a statement to the effect that no interest will accrue at least till the point in time that the first appeal is decided. So again, a very good move towards clarity. There's also been the decriminalization of a lot of the provisions, as well as a reduction in terms of the penalties and the prosecution proceedings. Overall, I'd agree with Mr. Sen about the budget. This is a budget that looks to the future. This is a budget that has a vision for 2047 and is slowly building up and creating the environment and the infrastructure and a platform that will allow India to be Viksit by 2047 and indeed dictate how the world is run in 2047. It also shows, on my part, it shows the willingness of the government to listen to a lot of the advocacy that was made to them. While yes, one can argue that a lot of these provisions only impact the big players and IT services companies, but there is a willingness to listen. And I think that is what we should take away as an MSME or a region, is the fact that the government is open to listening. And therefore, if there is a time for advocacy, that time is now. But it also shows, to my mind, that the government, when it talks about a trust-based relationship with taxpayers, they're talking about a two-sided trust. Why do I say that? While some people say that the retrospective amendments are in poor taste, how can you go against court decisions, etc. Another way of looking at it is to say that, look, all that the government is doing is that they are saying, don't take advantage of technical deficiencies or what we intended, which turned out to be a small drafting error. Don't take advantage of that. By all means, argue on merits and win your case on merits, but don't try to take advantage of technical errors. So there seems to be some sort of a thought coming from the government about the fact that trust should be two-sided. Finally, I would only say that, generally people are asked to rate the budget and, talk about how good or bad it is. I won't do that. I will only ask that anybody who evaluates the budget today should look at it in the context of what has been done over the last 12 years and perhaps even longer. Because for any policy to take effect, it takes that amount of time. Today, if you look at tax rates and tax slabs, they are simpler than what they were 15, 20 years back. If you look at ease of doing business, it has eased considerably to what it used to be. If you talk about labor reform, today the government has pushed it through. If you talk about incentivizing manufacturing, whether through PLIs or other incentives, the government has delivered. If you talk about MSME reform, there is a continuous focus on MSMEs and empowering them and simplifying procedures for them, whether that is allowing them to export goods now outside India to a greater degree without the cap, or whether that is allowing SEZs to export some of their products or sell some of their products in the domestic tariff area. And overall, if you look at a 12 to 15-year horizon, there is a far greater degree of certainty which has come into taxes, which to my mind is always the ask of taxpayers. I would only conclude by saying that people, companies, individuals often do not mind paying tax. What they want is certainty with regard to how that is done. And what they want is a return on their investment. The fact that you pay taxes should come back to us in the form of an investment by the government. And I think we do have examples of that which this government has put through, not only in this budget, as well as in previous year's budget. So with that, I'll conclude my opening remarks, and we have an economic session followed by a detailed tax discussion. So thank you.
Thank you, Mr. Dwarkanath. I now request our Vice President, Mr. Nabarun Sen, to please present a memento to Mr. Dwarkanath on behalf of the Bengal Chamber.
Thank you.
Yes. Thank you. We will now proceed towards the economic session, economic perspectives on budget 26-27. I request Professor Dr. Abhirup Sarkar, eminent economist and chairman, West Bengal Infrastructure Development Finance Corporation Limited, to please be on the dais and share the economic perspectives on the union budget.
Thank you very much for giving me this opportunity to speak here at this platform. I will share with you my own understanding of the budget. It's going to be an understanding rather than going into the details of the budget itself, which my previous speakers have already done. So I won't go into the details of the budget, but try to understand what the Honorable FM is trying to do, at least the way I see it. You see, to understand the budget, we have to understand what is going on in the economy, how the economy is performing. On the one hand, the economy is growing at a very comfortable rate. We all know that, around 7%, which is quite impressive. And on the other hand, there's there's a flip side to that. The flip side is that the international market is very volatile, and in particular, the rupee, the value of the rupee is going down. It has taken a real nosedive, if you may. And that has created all sorts of problems. One such problem is that foreign investors, FII investors, into the stock market, they envisage or expect that the rupee is going to go down further, and their investments are pulling out. They're taking out their investments and going out of the country. And as a result, the stock market is not performing well. So this is the flip side. On one hand, this there is growth, but on the other hand, the stock market is not performing well, and we all know the problems associated with a stock market which is not performing well. You cannot raise capital and so on. I won't go into that. And yesterday, after the budget speech, there was a big fall in stock prices. We all know that. Maybe people were expecting that there would be some direct support to investors, but that was not seen. And in addition, there was a transaction cost. There was a slight increase in the transaction cost so far as options were concerned. So taken together, the stock market is not doing well. On the other hand, there is comfortable growth. Now, first, let's try to understand what is the source of this growth. Last budget, there was a significant fall, cut in income tax. So there were, reliefs given. People had money in their hands. And this was followed by, around Diwali, this was followed by a reduction in GST rates. The purpose was to create more demand in the economy, to allow people to buy goods in the domestic market, which will boost up demand. So the philosophy was that, give concessions to the consumers, they will spend, and that will boost up the economy. And that indeed did happen. We can see that growth has increased and consumer spending has reached a peak. If you just compare it with 2012, it has been increasing. It has increased significantly. So one can say that the basis of this growth, it's basically a consumer driven growth. Okay. So this is one part. Higher demand in the domestic market. The other part, the fall in the value of rupee, stock prices falling, and foreign investments going out of the country. What was the reason for that? Well, if you look at trade figures, just if you look at export figures, for example, and you can also look at import figures, clearly growth of export is much less than growth of imports. In the common parlance, it is usually it's attributed to President Trump's erratic policies, a sudden increase in US tariffs, and it happens that we still export, 20% of our exports go to the US. So one can apprehend that Trump's policies are the root cause. If you look at the figures, however, you will find it's sort of surprising that exports to the US have not gone down so far significantly. If you look at the December figure, comparing December 25 exports with December 24 exports, US exports to the US have gone down very slightly, a little above 1%. However, other exports to other countries have significantly gone down. Exports to Netherlands, UK, Germany, Bangladesh, of course, there are other factors as well. Singapore, Saudi Arabia, Italy, Australia, Brazil, South Africa, France, all these countries, exports to all these countries have gone down, and gone down significantly. So one wonders why. Tariffs have been imposed by the US, but exports are going down. Exports to other countries are going down. This is kind of puzzling. So I will try to relate the growth in the economy, the consumer driven growth, with the fall in exports. Now, it has been observed in the past that in India, exports, at least in the short run, they are often residual. If the domestic economy is doing well, then our exports tend to go down, or they tend to increase at a lower rate. This is exactly what happened, I think. So in the short run, demand was created in the domestic economy. So firms tried to satisfy that demand, and the only thing they could do is to reduce exports in the short run. Because in the short run, you cannot increase productive capacity. So now we come to the budget. What was the idea behind the budget? To increase productive capacity. because that is the constraint. Demand is no longer the constraint, but if we could increase our long run productive capacity, then we can meet domestic demand as well as we can meet exports demand. I must point out that one significant increase in exports, this is very significant, is to China. We have been, it has increased by 67% December to December. So that is one, country where we are exporting a lot, and it really helps because transport costs are lower, markets are similar, and so on. But exports to other countries have gone down, and total exports have increased by a very small amount. So the idea is that to meet exports as well as domestic demand, one needs to enhance, one needs to expand productive capacities, and that is exactly what the budget is trying to do. Just one figure would suffice. If you look at capital expenditure as percentage of GDP, we can look at all other sorts of things, but just looking at this will be sufficient. Capital expenditure as percentage of GDP, that in 2019-20 that was 2.6%, and it went up all the way, it kept going up all the way to 4.2% in 23-24. So capital expenditure was increasing. We were spending more money on infrastructure. But then after the cut in taxes, revenue came down, and there was a pressure to manage the fiscal deficit. So capex spending took a hit. So from 2023-24, from 4.2%, 2 consecutive years, percentage of capital expenditure in GDP came down to 4% and then to 3.9%. This year, again, it has jumped up to 4.4%. So that was a big jump. And I'm sure the idea behind this is to enhance productive capacity in the economy. So demand has already increased. Now we have to increase the supply side. And that is exactly what the budget is doing by putting more money into infrastructure. So this is the way I see the budget. Now there are one or two minor failings perhaps, and one major. I'll talk about that. One minor failing is that, well, you see, drugs. People are expecting that prices of essential drugs will come down because import duties have come down and so on. That is a little bit problematic because, you see, if you reduce taxes, if a good, like in economics we call it goods of low elasticity, a fall in price does not increase the demand by much. Drugs are of low elasticity, they are essential. So a fall in tax is appropriated, the benefit of that is appropriated mostly by the consumers. They will increase their price because at the old price people were buying. So there is no reason to increase the prices. So my apprehension is that the fall in taxes may be accompanied with increase in prices, and as a result the final price that the consumers are paying may not change by that much. So a better policy would be to put a cap on the price of essential medicines. So this is one. The other is that, decriminalization. That's a good move, all right, but even in the past we have seen that these measures hardly transform black money into white money. So we have tried that again and again, we have failed. So that may not work, so to say. These are, of course, minor failings, but one major failing is that the budget sort of assumes that if there is growth, there would be trickle down to the lowest level. Now that may not happen. Well, that is going to happen, all right, but may not happen as fast as we would like it to be. So there is no mention of poverty, for example. It's assumed that poverty is not there in the Indian economy, which is not true. There was a measure of poverty, official measure of poverty, a few years back, about a couple of years back, which shows that poverty has drastically come down. Now there, the way the sample was taken is questionable. The population, the urban population, for example, was divided into three parts. People with cars worth more than 10 lakhs, people with cars worth less than 10 lakhs, and people without any car. Now, if you take your sample in this fashion, if you stratify the population in this fashion, most people in India do not have cars, of course. So you will be taking almost the entire population into one group. And if you pick up a sample, you will tend to get the average. Now, the average Indian consumption is, definitely greater than the poverty level. So, if you take your sample in that way, poverty is going to be an underestimate. So, poverty has not really gone down by that much. It has gone down by World Bank studies. Poverty has come down, but not by that much. So, there is still some need to address issues of poverty separately. There will be trickle down, but trickle down may not be as fast as one would like it to be. Thank you very much.
I request our Vice President, Mr. Nabarun Sen, to please be on the dais. And I also request Professor Dr. Obhirup Sarkar to please be on the dais. We have a pleasant task to perform. I request sir to please present a memento on behalf of the Bengal Chamber to Professor Sarkar. Thank you, sir. We will proceed towards the next session on taxation. We will take 2 minutes break for the changeover. Towards the next session, I request all the delegates to please be seated. We are moving towards our next session on an in-depth analysis on direct and indirect taxes. The session will be presented by PwC. I request the distinguished speakers from PwC to please be on the dais. Mr. Saurav Kedia, Partner, Pricewaterhouse and Company, and Mr. Dharmesh Shah, Director from Pricewaterhouse and Company Limited, LLP, sorry. I request the speakers to please take the session forward.
Good morning, ladies and gentlemen. Warm welcome to all of you. Thank you, the Bengal Chamber, for giving this opportunity to us. I'll be laying down a few of the direct tax proposals. As we are all aware, the Honorable Finance Minister has announced that the new Income Tax Act 2025 will be effective from 1st of April 2026. She has told that the rules would be announced shortly. So it is high time for the companies to gear up with the new law, do some changes to the IT system as needed once the income tax rules comes. So if you see this particular budget 2026, taxpayers are in a real transition phase. The old Income Tax Act is going to be repealed and the new Income Tax Act will replace from 1st of April 2026. This means that the government in substance only had this financial bill 2026 to make any clarificatory or any retrospective amendments to the existing law. Going forward with the new budget of 27 and thereafter, any substantive or changes or any policy changes can only be made in the new Income Tax Act. So possibly the government will have no chance to bring any further clarificatory amendment or retrospective amendment under the existing law. We are all aware that there are so many cases which are pending at a tribunal, high court and a Supreme Court level, and few of those judgments have been tried to be overruled by the amendments, retrospective amendments which has been brought under the law now. But I'm sure there are many other disputes which are going on in the various courts, which even if now the government try to amend, by bringing a clarification or a retrospective amendment, that may be difficult. And the courts have to settle those particular cases basis the interpretation of the law which is prevailing as on date. Moving on, as per the economic survey, if you see, the gross tax revenue has risen from around 10.8% of GDP in the pre-pandemic years to about 11.5% in the post-pandemic period, mainly driven by the growth momentum of the domestic economy and by the cumulative tax policy and the administration reforms which has been made by the government. If you see as per the survey, the share of the direct taxes in the total taxes has increased from roughly 52% before the pandemic year to nearly 59% in 24-25, which is mainly on account of non-corporate collections, which are rising from 2.4% to 3.3% of the GDP. Thanks to the capital gain tax, which has been introduced, which was the main reason I would believe, along with various other reforms, which was basically bringing the buoyancy and like the widening the tax base, I would say. In terms of statistics, the number of the income tax return filed has gone up from 6.9 crore in 21-22 to 9.2 crore in 24-25, supported by technology-enabled administration, stronger compliance, and more middle-class taxpayers now paying the taxes. At the same time, if you see, there has been a lot of increase in the litigation. As per the economic survey estimate of 22-23, around 11 lakh crore, of direct tax demand was locked up in litigation, and the department's eventual success, in getting these disputes decided in their favor was only meager 10 to 15%. So I would say a lot of scope, to reduce the litigation. And against that backdrop, I would say this particular budget has proposals have been made to maintain the rate stability, to use this particular transition year to bring greater certainty, reduce the litigation, simplify and modernize the law, and bring selective incentives to the key sectors and to the foreign investment to spur the economic growth. Now, coming back to the key tax policy changes which has been brought, there has been no major change in the tax rates. The tax rates remain the same. Dwarak alluded on few of the retrospective amendments which has been made to nullify a few of the court orders, basically challenging the proceedings on the technical grounds. So the whole focus, whether it is of the courts or whether it is the government, is on substance over form rather than on the technical arguments of the case. So if you see lately, be it the Ashish Agarwal case of the Supreme Court dealing with the whole 147 proceedings, or the very wide-spoken Tiger Global case of the Supreme Court, the whole focus has shifted from to substance from form, right? In terms of minimizing the litigations, there have been other good steps which has been taken in terms of rationalizing the time limit of assessment in DRP cases. There have been safe harbor rules which has been brought in particularly for IT sector, so that there is less of litigation on transfer pricing matters. Moving on to the other themes, if you see, there are certain incentives which has been given to few of the sectors, like a tax holiday which has been extended to IFSC, to promote more of these financial units to be set up in the IFSC. There have been regime re-engineering, to push the assessees to move to the new tax regime. There have been tweakings which has been made, which I'll be dealing in more detail. There have been a lot of steps which has been taken for simplification and rationalization of the law in terms of return filing timelines, filing your updated returns, in terms of decriminalization, a lot of penalty provisions, and I'll speak in greater detail about that. And then obviously, in order to spur, foreign investments, a lot of initiatives has been taken so that there is more foreign investment, particularly on the technology companies, I would say, in this budget. So moving on, in terms of return rationalization, that there is a change in the return due dates. We are all aware that the the return filing for the individuals and the non-corporate SSEs was 31st of July. But in order to give them additional time to compile their books, etc., that particular return timeline has been extended to 31st of August for non-corporate assessees who are in the business and profession, and the partners of the partnership firm who are in business and profession but not statutorily audited under any of the act. The revised return deadline was 31st of December. We are all aware that particular revised timeline was very skewed if you compare it with the original return filing, which was either 31st of October or November, and therefore the assessees hardly used to get 1 month time to file any revised return. So that particular revised return timeline has been extended by 3 months, but with a nominal fee of 1,000 if the total income is less than 5 lakh, but if it is more than 5 lakh, you need to pay a small 5,000 fee and you can file a revised return. There is a rationalization on the updated return. The scope of filing the updated return has been also extended to cases where there is a loss return. If you see the present law, in case there is a loss return which you have filed and you want to reduce that particular loss, you cannot file an updated return. Now that created practical difficulties, and therefore, now the government has allowed that in case you have filed a loss return, but if you want to reduce that particular loss in the return, you can always file an updated return. In terms of reassessment notice, if you see wherever there is a reassessment notice which is issued, you are given a 30 days time to file a return in order to disclose any of your income. Right now, you have an additional option that once a reassessment notice is issued, you can file an updated return rather than a return pursuant to the notice of reassessment, wherein in case you voluntarily disclose whatever undisclosed income you had in that particular return, you pay an additional 10% tax, and you don't, the penalty is not levied in such a case. So we are all aware that in an updated return, there is a graded tax which is there for 25%, 50%, 60%, and 70%. Now you have an opportunity that once a reassessment notice come, you still have not missed the bus, you can file an updated return, pay additional 10%. So it will be like 80% of the total tax which you pay, basis which though no penalty would be levied. I'll go to one more important amendment which has come in the buyback taxation. So we are all aware in the last year, the whole regime of taxation of the buyback had got changed. You know, people used to do some tax planning that instead of getting dividend from the company, they used to take recourse of buyback in order to reduce their taxation liability. Therefore, in the last year, to address this particular challenge, the law was amended, and it was provided that any consideration which is paid pursuant to a buyback would be a deemed dividend in the hands of the shareholder, taxable in the normal rates as a dividend is taxed, and any cost of acquisition of that particular shares which are bought back would be carried forward as a capital loss. Now that created a lot of practical difficulties for small taxpayers who were not doing any such sort of a tax planning, and they were still ended up paying higher taxes as per their slab rates, on those particular dividend amount. In order to address that particular issue, there has been an amendment again in this whole buyback tax regime, wherein in case you are a non-promoter, if you are just a shareholder, and if a company is doing any buyback, you will be paying a capital gain tax, because obviously there is a shares which has been bought back by the company, and therefore transfer of shares in your hands as a shareholder, which ideally should be a capital gain tax, which will attract a lower tax rate of 12.5% in a case of long-term listed companies, and in case it is a short-term shares, then it is 20%. Now, in case it is unlisted shares, then if it is long term, it is still 12.5% after the amendment in the long term tax rate, and in case it is short term, you pay as per the applicable rate. The change is now in particular for the promoter companies or the promoters individuals in their hands. So, in case you have a promoter holding company which has invested in the shares of any particular company, and it is receiving any consideration pursuant to the buyback, then the tax rate will not be the normal 12.5% on a long term. It will be additionally increased by 9.5%. So if you are a shareholder or a promoter holding company, in that case, you would be subjected to a higher tax rate of 22% rather than 12.5%. And if it is short-term capital gains, again it will be 22%, which is basically 20 plus 2. In case you are a promoter other than a company, in such a case, you will be taxed at the rate of 30%, which that means 17.5% higher. And again, short-term capital gain will also be taxed at 30%. Obviously, such charge would be required, such as applicable would be required to be added. Similarly, in case it's a buyback of preference shares or unlisted equity shares, the tax rate has been increased, particularly in the hands of the promoter or their holding companies. Now, one thing which we need to take care is that pursuant to this particular amendment, Section 50 CA would again get applicable. So, any transfer of shares in a buyback, you have to test Section 50 CA in the hands of the shareholder, that whether the transaction has happened at a consideration which is arrived as per Rule 11 UA, and if that particular consideration is lower than Rule 11 UA, then there would be an adjustment in the hands of the shareholder. Obviously, in a buyback, 56(2)(10 does not apply, so to that extent, we don't see much of a challenge. They have defined what is promoter. For a listed company, they have said that as per the SEBI regulations, you have to identify who is a promoter. For unlisted company, it should be as defined in the Companies Act, or the shareholders holding directly or indirectly more than 10% would be considered as a promoter company. Now, the cost of acquisition would be required to be reduced when you compare this whole capital gain tax. So, important change, I would say, which one needs to take care in a buyback. Moving on to another important amendment which has come in the MAT regime. So if you currently see that there is a new 115 BAA new regime which was brought, wherein the tax rate is 22% plus surcharges. So many of the companies, when this particular new regime was brought, actually moved into the new regime, right? And at that particular point of time, there was no benefit as such of a MAT credit to be carried forward for a company who is transitioning from the old regime to the new regime. But there were certain companies still who continued in the old regime because they were enjoying some tax holiday. Say, for example, a company is enjoying 80IA or 80IE sort of a tax holiday, and therefore they continue to be in the old regime. They didn't had any normal taxes, but they continued to pay MAT taxes, and they carried forward that particular MAT tax. Now, going forward, the amendment has been brought under the law to say that all those companies who are in the old regime, in case they continue to be in the old regime, then any taxes which they are paying under the MAT would be considered as the final tax. It means that you will not be allowed to carry forward that particular MAT credit. And in case you move into the new regime, then any credit balance which is available as on 31st of March 2026, you will be allowed to set off once you move into the new regime. However, they have given a cap that only to the extent of 25% of the total tax payable which is there under the new regime, to that extent you will get a MAT credit. The rest of the MAT credit you can still carry it forward for the next 15 years. So this is a very important change which has come. We were just doing some analysis. We find that in case you are a company who is you are enjoying a tax holiday, it makes commercial sense to still be in the old regime if your effective tax rate is lower than 14% under the after claiming this tax holiday. If say your tax is coming to 8% or 10%, it may still make sense for you to continue in the old regime and pay MAT tax as the final tax of 14%. However, in case your effective tax rate is more than 14%, then it is better that you move into the new regime. The only one point which came further for our observation was that there is some sort of a discrimination which has arisen, for assessees who had already opted for this new regime earlier, right? Because in the earlier new regime, you were not given the ability to carry forward this MAT credit and set off. But for the particular assessees who now, after this amendment, move into the new regime, they would be given a MAT credit benefit. And we were just going through the FAQ. The FAQ somewhere says that you had taken a business decision, it was a rational, you had taken basis the existing deductions, exemptions, and therefore it is justified that it was not allowed to you earlier. But I don't think that is the right justification which has been given in the FAQ. Possibly this creates a room for rate litigation, that there is clear discrimination for assessees who opted later versus assessees who opted before. Now, moving on, there have been certain other retrospective amendments which Dwarak spoke about. Earlier we were actually challenging all these assessment orders where this DIN, document identification number was not quoted either in the notice or the summons, etc. We used to technically challenge that it is invalid basis those circulars, etc. Obviously, those all these particular cases were pending in the courts at various levels. There were certain decisions which are there around it. Now, this particular, budget amendment proposes to retrospectively amend the law and say that in case the DIN reference is there in the assessment order in any so manner whatsoever, this particular proceedings would not be considered as invalid. So rightly so, because assessees were taking some benefit, not going on to the merits, but trying to get away with these technical arguments. I think they cannot do it any further because of this retrospective amendment. Any cases which are pending in the courts, I think they would now be decided pursuant to this particular revised, law which has been brought, and we need to see. Similarly, if you see, there was a dispute again on a technical ground that in case a reassessment notice is issued, whether it is issued by the jurisdictional assessing officer or the faceless assessing officer, and the assessee's point of contention was that it should be issued by a faceless assessing officer, not by the jurisdictional officer, because once you have introduced the new, faceless regime, then the jurisdictional officer to issue any notices also shifts to the faceless officer. So again, that was a decision which was pending in the courts. There were certain decisions in favor, there were certain decisions against, and it has been retrospectively clarified that any proceedings of 147, it is the jurisdictional officer's prerogative to issue a notice. He will first do 148A proceedings. After that, in case a 148 notice has to be issued, then the whole proceeding shifts to the faceless officer. So no confusion, this is the law you need to follow, and therefore it settles most of the past disputes. Likewise, there had been dispute on the timelines for passing your assessment order. So in case you have a transfer pricing case, you first have a draft assessment order, then you have a DRP order coming, and then the final assessment order coming. And there was a whole dispute that the section 53 time which has been provided for the assessment should cover the DRP part also. Whereas, the department view was that the 153 time limit which is there for a normal assessment would govern the stage till draft assessment order, and anything beyond that, which is DRP 9 months and then 1 month for passing the order, should be beyond 153 time limit. But so there was a dispute around that, and now it has been settled that quite clear that 153 is only till draft assessment order. I'd go with some other changes. There is an increase in the STT rates. The other important change is that in case you have any dividend income against any mutual fund or against any shares, and you had taken a loan for which you had some interest expenditure which you would have incurred, the law permitted you to claim 20%. To the extent of 20% of that interest expenditure, the law permitted you to claim in computing in your income from other sources, etc. But now the 20% cap has been taken away with. In case you have any dividend income from shares or mutual fund, there will be no deduction of expenditure of interest, etc., which would be allowed. But in case you are in the course of business, you are earning a dividend, then in such a cases, the interest expenditure should be allowed. Having said so, I just have one more carve out. Say, for example, you have a subsidiary company wherein you have made certain investments, and that investments have been made out of a loan which you have taken, right? In such a case, obviously an interest expenditure has been incurred. So the question is that whether you can still claim that interest expenditure as a normal business expenditure, to say that whatever investment I have made in my subsidiary, it is just a strategic investment for the expansion of my business, and therefore any interest expenditure should anyway normally be allowed to me under 36(1)(3), and I am not going to disallow this interest under income from other sources, and therefore those caps doesn't allow. In order to take this benefit, you can take the help of Supreme Court decision of SA Builders, which has now been reconfirmed when it was again referred back, that in case you are giving any interest free loan to a subsidiary and there is a commercial justification of giving those loans, etc., you cannot disallow the interest. So I think that same logic you can still apply, I believe, but it could be litigated, but this is something which we were mulling on. Moving forward, there have been an integration, very important change. One should notice that generally what used to happen is that you have an assessment order which is passed. In case the assessing officer has to initiate any penalty, he will just issue a penalty notice. He will say that I am going into appeal and please keep this penalty into abeyance till we have a final disposal on the merits of the case. Now, in order to remove the duplicacy of these proceedings, the government has proposed that the penalty proceedings and assessment proceedings would go together. And in the assessment order itself, the penalty proceedings or penalty order would also be passed along with in the same assessment order. Now, the good part of the whole amendment is that yes, there will be no duplicacy, but we were just discussing that maybe there will be a demand which would immediately come on account of penalty, which you need to take a stay, and once there is a CIT or appeal order, which is passed, and you go to ITAD, you then need to defend the stay for both your main demand plus the penalty demand. So the demand amount may substantially increase, for which you go for a for ITAD stay, I would say. The other beneficial thing which is there is that the interest on the penalty. Assume that you lose the matter at an ITAD or High Court level, the interest on that particular penalty would be from the CIT appeal stage and not from the assessment order. So that's the welcome thing which they have done. Dwarak had already touched upon the fact that the mandatory 20% payment of tax demand when you go to the CIT appeal has proposed to be reduced to 10%, but there is no mention in the bill. We could find mention in the speech. And likewise, there will be a joint committee of the Ministry of Corporate Affairs and CBDT which has been formed to integrate ICDS and INDES. We need to really see how this pan out. This will be effective from 27-28, but INDES is a complete different concept wherein you have notional basis of taxation on many things, and ICDS is something which still is on the old IGAP, which believes on historical cost and the real income theory. So we need to see how the convergence will really happen. But this is something which is a welcome move, so as to avoid duplicacy of doing all those adjustments of ICDS when you prepare tax computations. There has been a rationalization of TDS and TCS. I would just pick a couple of them, particularly your overseas tour package. If you see, it was 5% or 20% earlier. That has been substantially reduced to 2%. The whole objective is that whole of this business was going to overseas tour travel in order to, bring the business back to the domestic tour travel, travel agents. This particular rate would be helpful for them. Under the LRS, if you were sending the money for medical treatment or for other purposes, it was 5% and 20%. Now, under LRS, if you are sending for education or medical, it should be reduced from 5 to 2%. There has always been a dispute that whenever there is a supply of manpower, right, and if there is a professional services which is there was a dispute that whether it should be 2% or 10% TDS under 194C or 194J. Now they have brought the amendment to say that whatever be the supply of manpower, whether it is for professional services, technical services, or for works contract, the TDS rate should be 2%, so as to reduce any litigation on this. Likewise, in case you have purchased a property from a non-resident, you used to do a TDS. Now, in doing the TDS, you used to have a TAN specifically applied to do the TDS compliance under 195 of the Income Tax Act. Now, they have relaxed the requirement. Only in case you have a PAN, you can do the TDS and deposit. You don't need to have a TAN. There have been some rationalization on the penalty provision, very important. They want to avoid litigation because all these penalty provisions was discretionary in nature. And, there used to be a lot of dispute that you try to, prove your bona fide to say that penalty should not be applicable. However, now they have tried to convert this penalty into fixed fees. So in case there is any late TDS or TCS, filing, there would be a maximum fee of 200 per day, maximum up to the tax amount. Earlier, if you see the law, there was additional penalty which was discretionary under 271H. Similarly, if you see, failure to get your accounts audited, this is very important. Earlier, there was a penalty of 0.5% of the turnover or the gross receipts, or 1,50,000. But now, it has been graded. There is a fee of 75,000 if the delay is only 1 month. But if it is beyond that, then it is 1,50,000. Likewise, for furnishing of transfer pricing report under this transfer pricing report. So other than that, so penalty, we have already touched penalty and tax demand are now imposed together. I'll just move to the other amendments. So there have been substantial benefits which has been brought to the non-residents. If you see, particularly companies like Amazon, Google, Microsoft, etc., what they were doing is they were actually procuring data center services from Indian entities. So many a times they used to have their own data center over here, or they were procuring data center services from some companies over here. And pursuant to that data center services, they were providing cloud computing service to many of the SSCs or companies in India or outside of India. Now, certainly pursuant to these data center services, they were earning income, whether it was from India or whether it was outside of India from various customers. Now, the department used to allege that because you have a data center over here, pursuant to which you are earning a global revenue, you have created a permanent establishment and therefore you have to pay taxes. In order to incentivize them, there have been a new exemption section which has been brought, which suggests that in case you have any data procurement services which you are taking from any Indian company, right, and you are not yourself owning that particular data center, any income which you are earning out of that particular procurement of that data center services would be tax exempt, and that tax exemption would be till 2046-47. Now they have also made clear that in case you are providing any cloud computing service, etc., to my Indian residents, right, who are Indian resident, you cannot do it directly from foreign. You have to necessarily set up a company in India. Under a reseller model, you have to provide those services so that any markup which you are earning out of that residents which are in India gets taxed in India. So that's the good move which they have brought, that at least the global income, etc., will not tax you and will give you an exemption. But so far as you're doing business with my Indian residents are concerned, you have to open a company here and pay taxes. Likewise, if you see these all companies like Apple and all, who are setting up of their, you are actually getting manufacturing of mobiles, etc., in India through a toll manufacturing arrangement. What they generally do, they generally give a technology, they generally give a equipment, etc., to these toll manufacturers, basis which these toll manufacturers does a manufacturing. What the toll manufacturer does, it charges a conversion fee. Now, this particular conversion fee many a times is lower because the foreign company says, I have given my equipment, I have given my technology, and therefore the conversion charges obviously has to inbuild all this cost, and you have to subsidize me for this, so that you take only lesser conversion charges. Now, obviously, this actually resulted in a lot of litigation, that there can be a potential P attribution because your equipments, because of this technology, you should ideally supposed to earn royalty which you are adjusting with the conversion charges, or you are supposed to take rental incomes. And then these particular mobiles which are manufactured, you are anyway selling outside of India, so there is an income which you are earning out of certain equipments or certain technology or certain business activity which you have done in India. So, in order to address those particular cases, to incentivize these particular companies to come here, do manufacturing in India, they have clarified that they would like to give an exemption to these particular companies on fulfilling certain conditions. But I just note that in case this particular benefit has been extended to only those companies who are supplying capital equipment for electronic manufacturing, what about all other cases wherein somebody is having a same arrangement but not having an electronic manufacturing? Does it indicate that those cases will now be taxable, which is something which was a gray area? I'd go to the other amendments, which are transfer pricing amendments, very relevant, may not be relevant here. We may have very limited, clients here who are in the IT sector, but huge safe harbor markup which has been rationalized for these IT companies. There was huge litigation around the classification of these IT companies into software development or IT enabled or KPO or a contract R&D. So they have just merged everybody to say that going forward all these companies would be considered as ITS services, and we'll be charging a 15.5% on the cost base of these particular companies in India. So, there was a lot of APAs, a lot of litigation around this, that what should be the markup. And it's a very good move for the government to actually bring all these companies with a safe harbor of 15.5 so as to, avoid litigation and allow them ease of doing business here. In fact, one more important thing which they have done is they have actually increased the threshold of the safe harbor from 300 to 2000 crore. So I would say a very good size company also in IT sector would now be covered in that particular safe harbor rule, and which will certainly reduce lot of litigations of the APA filings. Moving ahead, on the APA, if you see, so basically in case you have a advanced pricing agreement which you go and enter with the advanced pricing authorities on any transfer pricing benchmark, right? For any transactions which you do with an associated enterprise, that is generally applicable for 5 years. There's a rollback and roll forward period. So whenever, say I am an Indian company, I have a transaction with an associated foreign company, and I am not sure that what should be the transfer pricing markup I should charge. So I go to my AP authority and take a blessing that, okay, this will be at a cost plus 15%, right? Now, what used to happen is that once an APA order comes, you file a modified return to give effect to the APA to say that, okay, the APA authority, I have done the transaction at 18%, but the APA authority says that it should be 15%, so there will be a 3% adjustment I need to do in my Indian books. There was no corresponding provision for my associated enterprise who was filing a return in India to do a similar sort of an adjustment. So I was really left either to file a mirror APA or to litigate to say that since in my other Indian company there has been an APA, you should allow me a refund of taxes, etc. So that used to create a lot of litigation. I used to don't have much of a possibility to claim those tax refunds. So that certain amendment has been brought so as to enable your associate enterprise to also file a revised return pursuant to a APA which is obtained by your other associated enterprise. The last I would touch is the GIFT City. We are all aware that the International Finance Service Center has been established in Gandhinagar to promote and make India a financial hub, and very welcoming tax holidays benefit which they already enjoy, which is 10 years out of the 15 years. They have now extended it to 20 years out of 20. Big, huge relief, I would say. Therefore it will basically attract all the other companies in other countries like Singapore or Hong Kong or Dubai, wherever they are. They would be more promoted to move their finance service center back to IFSC GIFT City because of the tax holiday. There are a lot of benefits which are also there for an India outbound company when you do investments outside, or you have a company which is set up outside, or you want to do some treasury activities outside of India. GIFT City is really coming as a real advantage. The other advantage is that in case you want to have a foreign currency exposure, right, and you want to have a loan which you take either from a foreign bank, many of these Indian companies are moving into these banks who are in the GIFT City to take these loans, because the interest rate is really beneficial compared to loan which you take from any foreign bank normally. So a lot of advantage on this GIFT City, and lot many companies are really looking up to it, for having those advantages. So this was all I had from the direct tax perspective. I would say overall this budget makes a very careful, confident handover from 1961 Act to the 2025 Act, which without doubt is a bold, great attempt to reset India direct tax architecture. It reflects confidence, it reflects clarity of the purpose of the government to simplify the law. However, as we say, the proof of pudding is in the eating. So therefore, we need to wait and watch whether the objective of the government is really met. Thank you so much for a patient here. Thank you. So I'll just invite Dharmesh, my colleague, to take you through on the indirect tax proposals.
Good afternoon, everyone. Good afternoon, distinguished members of the chambers, industry colleagues, and other guests. I am pleased to present here with the key indirect tax proposals announced in Union Budget 2026-27. So this year's focus for the government was on rationalization of tax structure, simplifying tax structure, support domestic manufacturing, promote exports, and enhancing the ease of doing business. So I will structure my discussion into two parts. First, I will take up the customs, and the second, then I will move to GST. So in customs, I'll first take up the changes made in the customs law. So the first and the foremost ask of the industry was giving some relief to the SEZ units. So there was a underutilization of the capacity of SEZ due to global headwinds and tariff which has been implemented across the globe, and that is why there was a huge underutilization of the manufacturing capacities. Now, one-time measures, they have announced that. So what happens whenever there is a sale from an SEZ to a DTA, it is considered as a import, and the importer needs to pay the import duty on the import of goods from SEZ. Now, as a one-time measure, they have announced that they will give a relief for a sale from SEZ to a DTA unit. The modalities are still under discussion because they need to ensure that DTA units are also not suffer the because if there is a tax, if there is a less of tax from SEZ unit, so the DTA units also does not suffer. So these modalities are still under worked out, but this will definitely give a lot of benefits to the SEZ units who are still under discussion because of the tariffs, they have been lot of underutilization of the SEZ units. Moving to the customs law, changes in the customs law. The first and the foremost law is there is no prior permission required for moving goods from one bonded warehouse to another bonded warehouse. So previously there were a lot of and if you want to move any goods from one bonded warehouse to another bonded warehouse, you need to take a permission from the officials. Now this has been done away with for ease of doing business and ensuring that there is a greater transparency. From one bonded warehouse to another bonded warehouse, there is no official permission required. Also, there is a change in the framework of the entire warehousing provision, and now it has become more digital based and operator centric. So the warehouse keepers are required to make it. It will be based on the risk based audit and based on the electronic filings. The second is on the voluntary payment. So under customs, under section 28 of the customs, if there is any fraud, collusion, if there is any demand on account of fraud, collusion or suppression, the taxpayer is required to pay tax along with interest and penalty. Now what happens sometimes is penalty is considered for the big MNCs and a lot of Indian big companies. This penalty is considered as penal in nature, and it can create an issue with the way it is represented in the in their accounts. So this has been brought under change, and now any voluntary payments of penalty will not be considered as penalty. It will be considered charge on the duty. So it will not be considered as a penalty. The second, they have been increased in the timeline for the advanced ruling. Now this has been made from 3 years to 5 years. In fact, for the existing rulings also, this can SEC can approach to extend the timeline to 5 years. This was a ask of the industry. The second, they have overhauled the entire custom baggage and regulations to consolidate all the declaration procedures related to the baggage in one unified framework. One of the important changes in the customs baggage rules is the green channel. So if any passenger is coming from abroad, previously if you are if you are having a if you are not bringing any goods on which duty is required to pay it, you can straightly go from the green channel. Now if any person is entering the country, they are required to fill up a declaration form the way we have it in other countries also. There is an Athithi app which has been developed, and you need to, before 3 days prior to the arrival, you need to ensure that you fill up that declaration form or on or before 3 days prior to arrival of the in India. Certain trade facilitation measures have been introduced in customs. The GST has been completely digitalized. Now, the government is also moving towards ensuring that entire custom process also gets digitalized. There are a lot of processes in customs which are still manual. We require a help of customs house agents to complete all the manual activities. Now this has been updated, and our honorable finance minister had hinted about the customs reforms in December also, and there are a lot of custom reforms which has been implemented as a trade facilitation measure. The first and foremost is the single and interconnected digital window. So for import of goods from different industry, there are different kinds of approval required. So if you are into import of electronic goods, there is a approval required from EPDMSC. If you are importing goods of foods, you are required to get approval from FSSAI. If you are importing any software or electronic product, you are required to take WPC license. So there is a single interconnected window which has been proposed to be rolled out by end of financial year 2027. The second, custom integrated system which has been planned to be rolled out, integrating all the custom related formalities within the next 2 years. One of the important, I would say, takeaway from this budget was the duty deferral scheme. So, as you are aware, there is an authorized economic operator scheme which was rolled out, which was in 2006 and then revamped again and again. Now, the duty deferral scheme has been updated from 15 days to 13 days. So, if any person importing goods and having an authorized economic operator status can pay duty within, not required to pay the duty immediately, but can be paid within 1 month. So if you are importing goods on the first of this month, you are required to pay the duty from the next first of the subsequent month. So this actually gives a lot of working capital requirement to the industry. This particular benefit is also extended to other class of person, that is eligible importer, manufacturer importer, eligible manufacturer importer. Now who are called as eligible importer, eligible manufacturer importer? Yesterday late night they had issued one circular also, wherein they specifically clarified that this eligible manufacturer importer will be decided and will be given approval by the Directorate of Customs. So we need to wait and see more clarity will emerge on who will be considered as the eligible manufacturer importer, who will also be given the equal benefit of duty deferral of 1 month. And that's a big trade facilitation measure, I would say, rolled out by the government. As I mentioned, new warehousing framework has been rolled out. A lot of thrust has been given on the digitalization in AI, as I mentioned. So AI powered scanning will be rolled out in the major ports for each of the cargoes. Export cargo using e-sealing will be given thorough clearance till the port, from the factory till the shipment. Then there is one more benefit given to the MSMEs. So a lot of MSMEs, artisans were exporting goods directly from e-commerce platform. Now, previously there was a cap of 10 lakhs rupees. So per consignment, you cannot export more than 10 lakhs via courier. Now there are a lot of artisans, a lot of MSMEs who are exporting goods through e-commerce. Now that relief has been given, and that value cap has been removed. 10 lakhs value cap has been removed. This was there in the budget speech, but we have not seen the fine print. So hopefully this will come by way of circular. Rate rationalization. So around, so as I mentioned, they have given the rationalize the rates and streamlined the rate to make it more easy for the industry. So around 100 entries, more than 100 to be specific, 102 entries have been rationalized, and the rates have been, so there are a lot of those 102 entries were, the exemptions were given. So tariff rate was notified, and then there was an exemption, and the effective rate was notified. Now these exemptions have been removed, and those effective rates have been given directly in the tariff to ensure more certainty. There are a lot of change. 102 entry, around 22 entries have been allowed to be lapsed. So exemptions will be lapsed by 31st March 2026. Some exemptions continued. So lithium-ion manufacture of lithium-ion batteries and battery packs and aircrafts, parts and components have been continued, and thrust has been given to the capital goods. Which will be used for lithium-ion cell battery, for manufacture of lithium-ion battery, for battery energy storage system. So any capital goods were imported for lithium-ion cell for when used in battery energy storage system will be exempted from tax. Some other exemptions, other baggage rules has been revamped. As I mentioned, baggage declaration rules along with baggage rules both have been revamped, and more benefit has been given to the personal import from through personal by individuals. From 50,000 the limit has been extended to 75,000. There is also a reduction in the dutiable goods imported for personal use from 20% to 10%. One more important, I think so, for this particular sector, leather industries, leather and textile industries. So previously, any inputs which were required, imported for manufacture of leather and textile related products, the timeline was given as 6 months. So you need to ensure that within 6 months you need to export the final product to claim benefit of the concession of import duty on inputs. Now this has been extended from 6 months to 1 year. Coming to my GST proposals, so the GST proposals are nothing, no surprises in the GST proposals, because all these proposals were already there in the 56th GST Council meeting, were in based on the decision of the GST Council meeting. The first and foremost is the place of supply. So previously the place of supply for intermediary service was based on the location of the supplier. So this was in fact creating lot of hindrance for the exporters, service exporters, because ultimately this adds up to the cost. There is no credit on the tax which will be charged by the exporter of service, right? Exporter of intermediary services. Now this has been done away with. Now the rules have been changed to location of the recipient, which will give a lot of breather to the export of services. And also for any flip cases, if there are any import of services, and if the location of the service provider is outside India, that will be taxed in India under reverse charge mechanism. The second is the post-sale discount. Now, post-sale discount, there were a lot of issues around, and there were a lot of advance rulings, high court cases around the post-sale discount, whether it should be allowed to be reduced from the value of supply. Now, since the entire GST has been digitalized, and there's a lot of thrust given on the IMS invoice management system, and the return process has been digitalized. So now this particular condition of having a pre-agreed agreement to pass on the discount, that has been done away with. And there is no linkage with original invoices required. The only condition required is to ensure that the recipient is is ensure that recipient is reducing its input tax credit. So this will actually give a lot of breather to the industry, because there was a lot of compliance requirements. Though there was no in the GST returns, there was no requirement to link the credit note with original invoice. But however, it remained in the act. So therefore, theoretically, there was a requirement of linking the original invoice with the with any credit notes issued. Now this has been done away with. 90%, a very welcome measure, that if you are if we are claiming refund under inverted duty structure, you will get a 90% refund. This was previously allowed only for the cases for export of payment with payment of tax and without payment of tax. Now this particular provision has been extended to the inverted duty structure also. And the lastly, provision has been unable to notify the authorities for advance ruling. So if there are conflicting rulings from two different advance ruling states, previously this was a national authority was set up, but however there was no bench which was been set up, and now this has been enabled. Now the tribunals can also hear the cases where there has been a conflicting ruling announced by the by two different authorities. That's all from indirect tax side. Thank you.
Any questions, please? No. I request Mr. Adhipnath Palchaudhuri, Chairperson, National Shipping and Logistics Committee of the Bengal Chamber of Commerce and Industry, and Chairman and Managing Director of Burmal Lorry and Company Limited, to please be on the dais. I request Sir to please present mementos on behalf of the Bengal Chamber of Commerce and Industry to the speakers. To Mr. Saurav Kedia. And to Mr. Dharmesh Shah. I request our group photographs, please, sir. Thank you. We will proceed towards the next session on industry perspectives on Union Budget 26-27. I request all the delegates to please be seated. I invite the panelists on the dais. Mr. Adhipnath Palchaudhuri, Chairperson, National Shipping and Logistics Committee, the Bengal Chamber of Commerce and Industry, and Chairman and Managing Director, Burmal Lorry and Company Limited. Sir. Mr. Dharmarajan Ashok, Executive Vice President and Head Corporate Taxation from ITC Limited. Mr. Oyan Banerjee, Director of Finance, TIL Limited. Mr. Borua, Managing Director and CEO, Woodlands Multi-Speciality Hospital Limited. He is on the way. He will be joining. And I request the moderator, Mr. Rajiv Basu, Partner, PwC, to please be on the dais. He's coming on the way. I request Mr. Basu to please take the session forward.
Thank you. Thank you. Right. So I think you've already, from the very morning sessions, you've heard a lot about the technicalities of the budget, and you've just heard two of our speakers talk about the tax provisions. What we'll do in this session is to keep it forward looking, because obviously the markets have reacted in a certain way. We are not going to discuss what could have been, but maybe taking the budget as given, what is it that we can do to kind of leverage or maximize the opportunities that have been thrown open by the sectoral policies that have been announced. So we'll keep it to the largely to a sectoral analysis, but I cannot resist Mr. Ashok being here, who's an elite and a very erudite tax professional, to dwell on a couple of issues that have been doing the round since yesterday on tax certainty. So maybe we'll come to that. We're waiting for Rupak. So as you've seen, Odip is here. Odip represents a logistic industry. So we've got a good representation here of the industries that are relevant for Eastern India. Rupak, healthcare, one of the most important ones. He's on his way, as I was told. Oyonda is here. Heavy engineering, manufacturing. This is what the East is known for. And of course, ITC is in so many sectors, and it's a conglomerate, so it's a good representation of how some of these provisions affect conglomerates. Now, before I get into some of the discussion on the sector-specific views, just a quick recap of what the budget has presented us with. Okay, and this is only factual. I'm not giving my views on whether these are good or bad, but just the facts. So again, the public capex has risen. It's 12.2 lakh crores. So there is continued public expenditure on infrastructure. Fiscal deficit 4.4 going to 4.3 targeted next year. GDP debt to GDP projected at 55.6. Some of the other economies are overheated, and we're trying to bring it down even further. That is what the finance minister yesterday mentioned. The GST collections showing a steady growth of 6+% year on year, which is another proxy of how the economy is doing. So that's a good sign. And on the on some of the initiatives that were specifically useful and very, I would say, very cheerful for the people in East and Northeast, you would see that there's been an announcement of a high-speed rail between Varanasi and Siliguri, and another new dedicated freight corridor from Dankuni to Surat. One good thing, and I've always been a big advocate of sustainability. One good thing that I find that's been announced in the budget yesterday was the 20 inland waterways, national waterways. So we've got a national highways, but then these national waterways, cleaning up the rivers and then using those as national waterways. Is another mode of transport. And I see Odip nodding there. It's another mode of transport. And of course, it throws up a lot of opportunities for transport and logistics operators. The other piece is on it being sustainable and plus connecting hinterlands to the ports. So this I thought was a great announcement yesterday. Now, the other pieces, there's been announcement on the electronics and semiconductor, biopharma and health economy. I think there are two sectors that have taken a huge, kind of space in the speech finance minister's speech yesterday. One was tourism, the other was on the entire healthcare, Ayush, biopharma, and the healthcare space. So I believe there's a reason for that, because you will have heard that there is a constant push on the part of the government to move to alleviate pressure of the cities. So you will see that there is the new cities industrial corridors industrial program has also been announced, mooted. So taking the pressure off the cities, and encouraging youth in the hinterland, the tier 2, tier 3 cities to become the health professionals, auxiliary health professionals, or associated health professionals, as they call it, AHPs. Plus the entire focus on Ayush. It has been our strength for centuries. It is seen as one of the potential export areas. The whole focus on wellness and health that the world has seen after COVID. So there's a big thrust on gearing up the ecosystem first internally within the country, and then probably we'll see in the next few years a big export push in this area. MSME and supply chain continues to have the focus, and there's been a lot of policy measures that have been announced for the MSMEs as well. Tourism and creative economies, we've already discussed that. It's garnered a huge attention in the ministries. And then also there's a lot of focus on education and skilling. So I believe if you just step back and look at what as a country we were facing in terms of challenges, the immediate major challenges, one is the big geopolitical uncertainty and turmoil, which needs internal manufacturing capabilities being even more bolstered and harnessed, plus increasing export competitiveness. The second piece is around the growing employable population, and those in the tier 2, tier 3 cities, the need to get them employment. So there's a big focus on that as well. And so those are some of the things that have been those are some of the aspects that have been kind of focused on, and you will see that a lot of these, and plus the AI, the whole push on AI that the entire globe is seeing on digital and AI, that has also found mention, and there's lots of impetus that's been given to the semiconductor industry. So with that said, and setting the context, and with the arrival of Rupak, I can get started now. So Rupak, I had the task to kind of make sure that the audience was engaged while you were arriving. So maybe with that background, I would probably come to Adip. Adip, and you are representing a conglomerate anyway, but your title that's been announced is the logistics sector head. So maybe I'll keep it to logistics here. So India's aspiration to become a global manufacturing export hub, and lots of announcements on internal inland logistics, plus the coastal logistics, etc. What opportunities are being thrown up for the logistics sector?
I think thanks for the question. Now, overall, there was a good starting point. You were not there at that point of time when Professor Abhirup Sarkar was speaking. So he had actually spoken in the context of, I think, export competitiveness. And we have to look at it in that same light, I would say, given the fact that there's so much of global turmoil, etc., etc. So how can we be more competitive? And with whatever manufacturing goods price, etc., is there, the fact of the matter that it gets reported is there's a 13 to 14% cost of logistics, as opposed to, which is supposed to be around 5 to 8% in large developed economies, including China, etc. So if all these points, actually this budget in that sense is pro logistics and works towards bringing it down. And how so? It's primarily about making a shift in the modal mix So we are largely a trucking-driven logistics economy. So we are road logistics, and there is around 25%, I think, freight rail logistics, and barring that, mostly it is road. Now, it is, I think there's some data point which talks about if there is a small shift of 2 to 3% between from road to rail, it has an impact of around 0.5 odd percent on even GDP. So it's an impact. And the other part is, if you look at coastal, so we've talked about coastal in this budget. We've talked about inland waterways in this budget. And by virtue of the freight corridors and the things like, there are in fact 7 freight corridors which have been talked about. What is getting talked about mostly out here is the Dankuni Surat, but then there are few more which are probably smaller in terms of, I would say, distance, but there are, I think, 6 or 7. And Varanasi Siliguri, which obviously creates a window towards the northeast. So if we are able to shift this whole modal mix from road, even partly, to rail, inland waterways, and coastal, it creates a logistics efficiency from 13 odd percent. I think the aspirations to get to around 8. Now that is going to come and straight away impact the competitiveness of the industry. So be it manufacturing, be it export, whatever you want to call about, think about, all of these would have, I would say, a direct benefit. And there are a few other, I would say, minor. I'm not going to use the word minor because there are things around customs. I think the previous speaker on the indirect taxes section, he spoke a lot about customs, and the clearance, etc. There is a whole concept about dwell time in the ports, trying to reducing it from 4 to 5 to maybe 1 or 2. All of these have got impact in terms of how the logistics costs come down, and hence it becomes more. So in that sense, I would say this budget is a forward-looking budget for sure, as you said, in terms of, and it also represents continuity in terms of our larger goal of being more Atmanirbhar, more competitive, and of course helping the overall economy and the country grow.
No, thank you. I mean, this you've really summed it up very well, and I would just top it up by saying that probably it also presents some direct and indirect employment opportunities for when you talked about movement from road to other modes. So that also presents employment opportunities, and you will see that it's been supplemented by some impetus that's been given to the shipbuilding and the ship repair industry, which it goes hand in hand. So that's a very good opening statement, Adip, from you, and I see that you're very positive about the opportunities that it throws up in terms of both employment as well as alternative mode of transports and the overall competitiveness therefore coming up. Good. Now, as I said, Mr. Ashok, can't resist asking you about the retrospective clarificatory amendments that have actually effectively nullified some of the judicial pronouncements. And there were some conflicts around, the JAO and FAO conflicts, plus the DIN-related defects, etc., which the law went one way, the courts actually they passed orders in favor of the assessees, and now we're seeming to be going back. So how do you see? I mean, is this do you see this as a big hurdle? How do you see this as in the context of tax certainty and the overall mood?
Yeah, see, like Dwarak mentioned at the beginning, these are seen as technical kind of defects, which the legislature in its wisdom wants to rectify. No quarrels about that. But let's look back also. What has happened? Last 3-4 years have gone by. Several disputes have happened on this JAO versus FAO controversy. KDR spoke about Ashish Agarwal case. And all this of kind of what has happened, it has gone to thicken the packets of the advocates and few of the consultants as well. In the last 3-4 years, the government could have clarified immediately instead of allowing this to fester for 4 years. As an industry player, I see like DIN as a document identification number. The background for that was what? There are instances where the assessing officers were issuing a notice without recording in their records, just to threaten or intimidate an assessee to come and meet him. You know for what purpose. That's where they brought in that every document which goes out of the department should have a DIN. Now the government says, okay, what if the DIN is not there? You take it as issued by the department as long as, or so long as it appears somewhere. Where it appears, that is not clear for me. Our own case, we have a case where there was no DIN, and the assessing officer spoke to us saying that I want to issue backdated. We said nothing doing. We will not accept it. So they got caught. They issued a notice without DIN. Now we have challenged it. Now this is the amendment which has happened retrospectively. Whether it will also dilute that position, what has already happened, and where we believe he had lost his limitation by leaps and bounds. Now what happens in such instances? See, that is where the problem comes, the background of introducing a particular provision and subsequently getting diluted, saying it's a legislative intent. See, I agree. Legislative intent is clear, it's technical, I agree. But there are certain this kind of breaches which goes to the root of a particular case. That has been lost is what I believe.
No, I think you're speaking for many when you say that, and well, it needs to be seen whether there are any further clarifications or fine prints issued in this. But whatever has been said, the views are that there are issues that might need to be dealt with on the way to absorb these kind of retroactive amendments. We'll have to see, and maybe probably there will be representations from chambers, etc. I don't know. I mean, as long as we are all tracking this and seeing how is it really affecting business or creating more complications, I think things will unfold on the way. Anand, I have to come to you now. A big sector in East, manufacturing, and we've been told that there is an attempt to crowd in private investments. That is the intent of this budget. And of course, your industry is for long-term capex, a long gestation period of more in the nature of capital equipments that TIL does. So what is the fiscal or the capital market tweak that would really make this happen, reducing cost of capital and attracting long-term patient capital, which is the intent of the budget?
Thank you, Rajiv, and good morning to all chamber members. This is not only for heavy industries, what you are talking about, this is for all industries who are looking to reduce their cost of capital, which is very intrinsic to do things profitably. However, the budget is trying to do, I think, a lot to reduce this pressure. If you really see the gap, the trade gap, what they are trying to cap within their target budgeted limit, this is one of the major steps to reduce the pressure on the economy as far as the imbalance is concerned. Essentially, what we are trying to say is that if there is a foreign currency upward swing, which we are seeing unfortunately with some geopolitical situation you have talked about, which is creating a lot of pressure within, there is a pressure of foreign currency going out, and therefore there is a pressure on the market to increase the cost of capital. Having said that, the budget is trying to reduce the interest costs, not directly. Its inflation is under control, gap is under control. Thereby, it is creating an environment wherein the general macro element of the economy, both monetary sector as well as the other operational sector, remain under control, and this becomes stable. How far it reduces, this needs to be seen, Rajiv. I don't see that it is going to be reduced quickly. it needs to be stable to start with. And I think I'm very happy to note Mr. Adib was talking about the freight costs. Essentially, when it starts reducing, the other element starts at least stable, the cost of capital remains stable, the bottom line becomes a little, I would say, bigger for the industries, especially heavy industries, and especially coming from the east to start with. That's it.
No, so basically what you're saying is the impact of this still needs to be seen.
Absolutely. I mean, needs to be seen a little more because just budget is out. I'm expecting this to be rationalized a bit. The pressure is high, considering all other thing into consideration. The foreign money coming in at this point of time, what you are directly asking, is there. There is a chance, but then the situation is such that we need to be, much more patient to look into how these are coming in.
No, you're absolutely right, and we cannot ignore the fact that there are a lot of other forces that work on this particular aspect. For example, the Fed rate that is a big determinant. Plus, how the other economies are doing. What is the level of global uncertainty? Is India being seen as a safe haven for investments, etc.? A lot of other things that we really can't control at times. So I agree with what you're saying, Rupak. Your sector, as I was mentioning in my opening remark, is one of the sectors that's been spoken about yesterday at length. And we really love it because Eastern region is and has been very healthcare positive. And I would say it has got all the potential to become sort of a healthcare hub because of the quality of medical professionals, plus the catchment that we have, the neighboring countries, etc. So that said, and there's been a lot of discussions around boosting medical tourism, plus the whole ecosystem around it. So what's your view? Is this really something that healthcare players, large or medium-sized, of which there are many in Eastern India, can they look forward to some refreshing opportunities again to kind of dig deeper into the market, spread further?
Thanks, Rajiv. First, my apology. I just came a little late. I was coming from the hospital. Yesterday's budget presentation, Finance Minister elaborated a lot on healthcare, but this time healthcare shifted a little bit in focus, shifted in a different way. And as you were mentioning, yes, of course, the healthcare sector is growing. It's all over India, it is growing, and of course, in Eastern India, particularly, we have seen there is a lot of growth happen last 7-10 years. Healthcare opportunity is there because 1.4 billion populations, and to meet up the healthcare support, healthcare services, we need a lot of expansion. That is, of course, so expansion in terms, what was our expectation from the industry, which we had submitted before this pre-budget expectation. There is a major part that we talked about, that is the healthcare public expenditure to increase. Because healthcare, if you are talking about expansion, it is expanding in the private sector. But if expansion of the private sector, it happens more, there is two major issues related to healthcare. One is accessibility and one is the affordability. Now, in terms of your accessibility, yes, of course, many of the hospitals coming up, many of the different areas. So people used to go out of the city or out of the state for better medical treatment. Now they are getting medical services here, but at the cost. Now, major issue in healthcare, Indian healthcare, is the out-of-pocket expenses, because people are paying common citizens, they are paying from the pocket, because yes, of course, there is a little bit less insurance penetration as of now, and more it is coming up, but still there is a it's a state subject. Government healthcare is a state subject, but still there is a lot many things from the public expenditure should come up. That was we are expecting that at least the health mission's goal, actually it was 2.5% of the GDP should be spent in healthcare. Still, we are hovering around below 2%. It is almost 1.8, 1.85%. So public expenditure, until and unless public expenditure is not increasing, then infrastructure and all from the government side is not going to happen. Then, and as you were mentioning, the healthcare, opportunity, yes, lot of opportunity, because there is a not much of thing happening from the government sector. So because there is a fund crisis as well, particularly in the tertiary and quaternary care, high-end surgeries and high-end medical support system. So here is one of the areas that's a concern. So opportunity is still there, huge opportunity. This is a last BGPS that we have announced, almost 11,000 crore investment is taking place in next 3 to 5 years time in terms of healthcare expansion. But that is one part. But now this year, if you see that that shifted the focus from therapeutic medicine or the straight treatment then to wellness, or it is a diagnostic or more of the wellness care or preventive care that they were talking about now. So that way you will must have seen there is a lot of new projects has been discussed, though major initiatives not yet been announced. But so far the preventive care is concerned, shifting off from the therapeutic, it is of course it's one of the major discussions today, because before this budget, actually we used to talk about in many platforms that wellness or the preventive care we must give lot of attention, because every time people will fall sick and they will reach out to the hospital. It is not the ideal situation. People should take care of themselves. People should take care. So one area that has made government quite progress in terms of communicable diseases means your leprosy and your tuberculosis. Those are the common malaria, your cholera. These are the communicable diseases actually has been controlled. Your maternity death rate has been controlled in many ways. But now they have shifted from communicable disease to non-communicable disease. That is related to lifestyle, which is a major concern today for each and everyone. That is your cardiac diseases, your cancer. These are the diabetic. These are coming up in huge proportionate way, and it is now major concern. And government actually had shifted in a very right way. There is a preventive care, more wellness care. And that is that there is a major expansion we are expecting that is going to happen both in terms of private and public. More we can discuss later on in terms of in-depth study.
Thank you, Rupak. And yes, Ayush, a majority of what's been discussed in healthcare is Ayush. And I was also mentioning probably the government. There's a thought in the government that this is age old. I mean, Ayush is age old in India, going back to thousands of years, and the revival of this in this ancient, preventive wellness, treatments, etc. I think there's a lot of export opportunities also inside, because the Western world is also moving towards wellness, which is what we were discussing. Thank you for your comments there. So it's a mix. I mean, you're saying that there is opportunity, but you would have also like to see some more public expenditure trust in healthcare, just to give them the boost. Yeah. Adip, I'll come to you. In terms of the customs duty rationalization, a lot of, and we briefly touched upon it in your earlier remark. How do you see industry, and second is particularly the logistics sector? So do you see more traffic, more opportunities of international trade happening? Is it really going to boost international trade? Plus, of course, logistics, particularly from the customs duty rationalization side.
See, on I'm going to refrain right now from speaking on the rationalization part, but I would rather speak on the aspect about the single window digital clearance and the fact that in a span of around 2 years, I think they've spoken about, it will cover the entire gamut and make sure that it is much more faceless and AI driven. Now, I would rather pick that because individual duty elements can come and go depending on, I would say, the ebb and flow of the economic push and pull across the world. So I would steer clear from there, but I would definitely think that to be extremely positive, because this entire I mean, we ourselves are running CFS, container freight stations, but as people who are running CFSs know, that actually a business opportunity which has emerged out of the inefficiency of the port system, because otherwise your containers are staying at the port, which means huge demurrage, take it out and keeping it at CFS. But CFS rental is also not so less. So once again, I would say it's in the journey of government is actually consistent, because they came up with the whole concept of DPD, DPE, which is direct port delivery, direct port export, which is in the concept of extending the whole thing of ease of doing business. And now the dwell times have already come down, but then they need to come down further. And that is where the connectivity with the hinterland. So if there is a port, and how soon can it go to the unit, and how fast and how economically. So there are in fact also announcements regarding these waterways, incidentally, are connecting to Paradeep and Kandla. Plus also there are investments talking about railway tracks getting laid to the port. So through that, I think that efficiency is going to come. So customs as a concept, as we move more from ports to this whole ICDs, you can see the whole customs regime actually going much more beyond just the port or the airport. And the same would also be applicable to bonded warehouse, because there was also talk about bonded warehouses, and this gentleman earlier talked about. So if you look at from that entire gamut, I think it's more industry friendly. It will cut down on, I think, the paperwork. Certainly, it will cut down on the paperwork, which got to be digital. It's bound to enhance efficiency, transparency, like the way Mr. Banerjee talked about, Mr. Ashok talked about the DIN, etc. Equivalent things. I'm not saying they're exact parallels, but I think that overall transparency, efficiency of the customs regime, that is going to definitely go. And that's going to be a boon for the logistics.
So in a way, yes, in a way, I think that really is a sum up of your view on it is going to really mean good for the business, and obviously on the margin you might see that has added to the business. We would obviously wait and watch, but definitely efficiencies and cost of doing business goes down. I mean, literally, that is the impact. That's what you're saying. Mr. Ashok, new act, Income Tax Act, and a lot of transition provisions, and people have taken positions, tax positions, and they've given the provisions that were there at the time when the planning was done. So what kind of transition provisions do you want to see, and how does it, again, I'll talk about the certainty, tax certainty. What kind of transition and transitory provisions do you see would really help smooth transition to this new act?
Yeah. See, now the new act is a reality, and it was reaffirmed by the minister yesterday. She also mentioned about the rules and forms will be notified shortly. See, as a corporate, as a C, that's very important. It should have been announced by now so that the front-end operation teams can be familiarized. Back-end systems, SAP, ERP system need to be reconfigured. And we are not sure. For 31st March, we have to file a return by May, TDS returns. Okay, now what form to be used? Salary annual return should be filed, 24Q. Which form to use? Because by the time next financial year will come, new act, whereas it relates to the financial year 24-25. So I presume, I only hope that transition provisions come about clearly so that there's a smooth transition which happens to the new law under the new forms. I only wish that announcement had happened earlier. At least they should do it quickly so that we can reconfigure our system. That's the first part of it. The second part is very, very important, is the interpretation of the various terminologies used in the hitherto 1961 Act. So judicial precedents have evolved over the last 60 years. Many scholarly people up to Supreme Court has interpreted certain provisions. Whereas under the garb of simplifying the language, quite a few established terms have been replaced with a simpler English. I only wish and pray the department does not re-agitate established principles, because the same section or same words which have been replaced under the new law does not get call for a new interpretation. There will be I would say, sea load of litigation which will start again if established principles are kind of gets questioned again by the department. Of course, I heard a Supreme Court counsel speaking to me the other day when he talked about this new law coming into play. He said, Ashok, not only me, my grandson also will study law and make intergenerational income. So that is what he's forcing. He said, don't expect any such thing. It will be litigation forever. While he was happy for himself, I don't want to be so pessimistic, because the intent of the government seems to be to simplify things. I only hope they come up with that such transitional provisions.
I think you have really spoken the voice of the entire industry, because this really needs, and on a much lighter note, I was just seeing one post on the social media. There was one gentleman who was actually calling for these clarifications because the CS students have to write their exams. So he's saying that there are so many students who are lined up, how do they know which provision is going to take what shape and what interpretation and what are the forms, etc., which you were mentioning. This is spare the students, at least for the students, please declare fast. So it was on a lighter note, but he was making that comment. But yeah, on just being on that point, it is definitely something, again, which I know that you don't have an answer, but you've given some very good points on particularly the point on interpretation of terms that have been hitherto used and now being replaced for for simplicity. Will they have some other meaning, and will that give and how does that actually map into what you have done in the past based on some other term which is supposed to map into this term, and then it's a different meaning?
I can only supplement. I saw a Supreme Court, Mr. Arvind Dattar, Supreme Court Senior Counsel. He's already written a treatise about notwithstanding, which was appearing into the 1961 Act, getting replaced with subject to. He said it could be a different meaning altogether. He says.
Yeah, absolutely. And they would pull out case laws to show how these could be interpreted differently. So yeah, I mean, this is a good time for people like us probably and the lawyers, but but it's not good for the industry to be in such in a state of doldrum. So yeah, I appreciate and I really sympathize with the situation. On the just one very teasing question that I had, and I've saved this to ask you in terms of the the components, the customs duty on components, raw materials, again, going to the indirect tax and finished capital equipment, there have been revisits to some of these aspects. Does it really promise to alter the cost structure a bit on the logistics? I think Adip touched about, but in terms of the cost of production, cost structure, plus localization and price competitiveness.
Rajiv, I think we need to be very mindful that whenever the budget comes, I mean, people like us and all who are present here, we try to get many things out of the budget. If you systematically see that maybe last decade, we are seeing budget is much more becoming a guiding factor in a long term rather than becoming myopic of any percentage change on any particular element or reducing, except how much it is pinching my pocket from salary part. Others are much more procedural. To answer to your point, it is much more important to note that the trade deal between EU and India has got much bigger impact of the production cost of capital goods in India, especially the company I represent, the crane manufacturing, or for that matter, capital good as a group, we are manufacturing mining, heavy industry, machineries underground or overground. Those come into the play. The current disposition of budget does take care of. I was listening your presentation, PwC's presentation. There is a 15 days additionality of credit as far as the customs duty goes. There could be certain more fine prints of reducing of some duties, some product which we are not yet very clear. We are understanding the HSN code and trying to get the numbers. But if you really see this budget of rationalizing the customs, giving lot more avenues of going from high cost to low cost river transport, etc., the EU-India trade deal will bring in a lot as far as the reduction of costs, especially the customs duty is concerned. Having said that, if you see it's all being, we are accountant, the function of duty is based upon the landed cost of material. Again, I am at the cost of repetition I'm talking about. If the foreign currency is going towards north, and whatever duty impact or reduction you are talking about will be eaten away as a multiplying impact. So therefore, again, I'm repeating that factor that the stability of the rate, the other costs related to it has to be, we have to wait and see. The customs rationalization, there are a lot of good things which has happened, the bonded warehouse scheme, the riverine transactions, transportations, which is coming in, which help a lot. But the benefit to the industry at the end will come depending upon multiple factors. Yes, the credit days increasing helps a lot. The export-oriented unit who are importing at the duty-free and then goes for the export, also we are taking that advantage. It is currently on, will be helping. The import for nuclear power manufacturing, there are specific exemptions that will be really helpful. But again, these are all function of certain landed cost, and it's important to note what's the landed cost going to be.
It's a very good point that you brought out. Probably we couldn't focus on it much, and it's not within the purview of this discussion, but definitely to be remembered, and which I'm personally also talking in some other chambers where I'm part of, is the awareness of the opportunities being thrown up by the FTAs. It's a very good point, Ananda, that you brought out. And I think all of us in business over here, you should read the fine print and make the most of those opportunities, because there's one UK FTA that's already in place now. Yeah, absolutely. There has to be a session on this. And actually, honestly, I mean, I'd request Bengal Chamber to kind of set up some desks to make sure that the experts who understand these FTAs, they are available as helpline to the members for clarification. And then they can, again, liaise with the consuls, the respective consuls, to get clarification and also facilitate the trade. I mean, this could be good business for the chamber as well, and a big service for the members. But anyway, I'll not lecture much more on that. I'm putting this as in some other chamber, so you might also want to take note of this. But yes, I mean, that's a very good point on that you brought out. Noted. Rupak, the last point, I'll come to you, which is on the imported medical equipments. Again, customs, the easing out of customs, and plus the AI, the whole AI piece, AI in healthcare. So these two aspects I'd like you to focus on. Do you see the budget really actually forwarding the healthcare agenda in these two domains? One is the imported medical equipments, and the second is the use of AI in healthcare, which is very important. I mean, I read somewhere that AI actually could sufficiently and significantly boost the gap in the patient to doctor ratio by doing the initial analysis, which probably, it'll take some days for a doctor to even for a patient to get into the queue of a doctor. An AI machine could do that and give the initial diagnosis. So I don't know. I mean, you will know better, but just your views on those.
Yeah, Rajiv, this AI is, of course, or digitization's technology. It's a driving healthcare today. it's extremely important subject for discussion. That is how technology is taking forward the healthcare, and the future of healthcare is lies on technology and whatever. Now that we talk about AI in healthcare is not today. AI is working for quite some time, but not in this advanced mode. But of course, this IBM introduced one cancer diagnosis through this your AI, and within a short time, this they will analyze, but the same kind of disease, because cancer has become now is very even every part they have, and every individual they have the same part, but in every individual they have their different kind of a response to the treatment. And now this AI is taking place, and different kind of method actually has been introduced in the healthcare sector today. That through AI, how we can diagnose a patient without much of delay, and the precision based treatment. Actually, that is the most important part for AI. What AI is doing right now, precision. Yes, of course, the way time consuming for understanding a diagnosis, because sometimes some of the critical health disease is very difficult. Sometimes it becomes undiagnosed. But this AI actually is taking shape in big way. It is coming up. Already a lot of research is happening further, how more AI can, for a patient benefit for the treatment, can support this healthcare. But in this budget, actually, not much of digitization discussion happened, because that was our expectation that more investment should take place in ABDM, Atmanirbhar Bharat, a digital mission. That is, the government has created one portal actually, that's a ABDM. And through this ABDM, each and every citizen or each and every population actually will be able to trace their all reports, diagnosis report and all is a portable one, which means is from one place to other place, or one hospital to other hospital, whether it is the private or the public, one data, one UHID or unique number on the identification number will carry, and that report, all these reports, so that you should not carry all the physical reports along with you, or you have lost those physical reports, but this will be available. So someone is consulting a government in a government hospital, and suppose he needs better treatment or advanced treatment in any private hospital, so that data or that kind of a reports, everything it will be available through this your portal actually. But there and more these digitizations will take place, or AI will help us, because our one of the major concern in healthcare, it is reaching out to the tier 2, tier 3 places, because the 70% of the total population is in the rural districts. I mean, in the tier 2, tier 3 places, even the tier 1. But the major issue here, the challenge is, if you find that whatever the hospital infrastructure we have, that is all in the urban area, where 25 to 30% population is there. So this, how we can take these medical facilities to the tier 2, tier 3 places, that is one of the major discussions today. And that is going to help us, this your digitizations, your artificial intelligence, to take these medical services to the remotest people, because remotest segment. Otherwise, people traveling a lot. And for sometimes it happens in a district level. For a dialysis, one patient has to travel 50 kilometers. And the dialysis, need thrice a week. And so 50, 100 kilometer, one person is traveling to do a dialysis for 4 hours. That is the situation in the remote village. Now, this will be, yes, of course, that need more of investment, but otherwise dialysis cannot be digitally. But in many of the cases, today, that which is possible through this your lot of digitizations happen already. It's coming up in the big way, that without teleconsultation, and that teleconsultation has reached out in a different level. Each and every patients can be there in the remote village, and the doctor, they can consult in some place in the urban area where they can be treated, they can be diagnosed all in through teleconsultation. Now, robotic surgery, if you see, now the robotic surgery is a very high precision based surgery. If you can see, there's a robotic surgery in all places. But because of this, the 5G is in place. Now, one surgeon is sitting, because robotic surgeon is not available in every places. It's very, very rare commodity actually. So it's a very, very highly skilled subject for discussion. Now, this one doctor can operate sitting in Kolkata, can operate in remote village wherever there is a proper network system is there. So this is the advancement is happening in healthcare. But this year, this budget actually, as I mentioned, it has been shifted from we have just shifted to the ancient level. Though we all talk about digitizations and everybody, we are working on that. Yes, of both public and the private. We are heavily investing in digitizations and the AI. But this year, I think the government has shifted to this your ancient therapy, the Ayush alternate medicine, and this message is for all of us. We'll have to keep and that is the reason this year, they have shifted to this ancient level just to control this your non-communicable disease. That is your diabetic, hypertension, your cancer, because the way cancer is increasing number, 1.4 million patients being reported, fresh cases being reported every year for this your cancer diagnosis. And how many cancer center can come up? Not many. How many? Because one cancer center, only the medical equipment cost is more than 50 to 60 crore. So and that is not end. One is the investment machine, and one is the man behind the machine. So you need the skill, human resources to manage those equipments. So there is a main objective of this budget today, that is a shifting, so that we should all take care of ourselves. We should go for more this Ayushman, this Ayushman Bharat that the government introduced 3 years back. Now, accessibility that they have given. Now, this year, apart from the digitization, though it's a major subject for discussion, but in individual level that is happening, and government has taken major steps in digitization by introducing ABDM and working heavily. But this year, that shifted from this your therapeutic procedures to wellness. Even this one of the major area that Indian healthcare is getting, that is a medical value travel, medical tourism. You'll find that is it's almost, we have reached 9 billion revenue, the foreign exchange from this your medical value travel. From this, all over the world, it has been, Indian healthcare has been popular today. But now that has been shifted from the therapeutic to this your wellness. That's why you must have seen this year, there's 5 regional hub that they were going to create with the PPP mode, because government will not be able to handle this one. So it's a PPP mode. So there are more regional hub where diagnostic, wellness, rehabilitation, all those swings will be discussed. So more, I think this time we are little bit, the government has given a pause and gone for ancient therapy, more, even the biopharma, because biopharma is very effective in terms of cancer, cardiological diseases and all. So additional 10,000 crore has been allocated for the biopharma knowledge, innovation, research. So biopharma will come up. One part also they have given this time is a mental health. You see, there is a NIMHANS, there's a National Institute of Neurology and all. That is another 2 centers is going to come up. Because mental health sometimes is we don't give much of attention. But each and every population, there you'll find there is some kind of a stress and strain, and there is a mental stress, and there is a mental health support is required. So there actually government has given a lot of support. So this, of course, modern treatment, modern therapy is continuing. Digitizations, AI is going to give a different kind of a shape to Indian health. Not only Indian healthcare, is a globally, but Indian healthcare we are talking about is going to get a lot of support. But of course, we need to take care of ourselves. We will have to keep ourselves fit so that hospitals should not, we should not rush to the hospital for treatment. So that we should control that part only. Thank you.
It's a very good sum up of the current health situation that we are facing in India, and relating it back to why the budget proposals have been as such. Why is there so much of emphasis on prevention rather than being therapeutic? So that was it could only come from you, Rupak, because you have such a good view of the whole industry. So really, I'm really feeling very rich with the knowledge that you've just now given to all of us. 2 questions I can take because I'm mindful of time. We're almost out of time, but 2 questions. And please name the person who you want to address a question to. 2 questions. No questions? Please. Yeah.
Mr. In this robotic surgery, the robotic surgery is coming in a very good way, and it will be happen, right? So in that case, suppose the robotic surgery, the doctors is keeping this outside and the patient is another side. And total surgery will be going through some network system. Now in the peak of this operation, there is a network is failure. Then what will be happen?
Yes, this is a question, but you will have to have enough backup system whenever you are doing surgery, because you are dealing with a human life. So the enough backup system has to be in place, whatever way possible. That is yes, of course, anything, anytime can happen. But suppose in a OT, there is can be disruption, electricity power can go up. But we have a UPS system, uninterrupted power supply, that we are maintaining. So that way you will have to come up with, there's a 2-part in terms of your remote surgery through AI. One is a proper kind of a network system has to be in place, that you will have to oversure with proper backup system. And the second part is proper kind of a skill manpower has to be there. Some surgeons, they do not have the equipment. They do not have that kind of an expertise. But because these are all mostly is a laparoscopic surgery. So in case something happen, in this, of course, can happen anytime. They will open and they will do the surgery. So there are the surgeons available, equally skilled surgeons are available without the robotic system. Robot is doing their cases, and anything happen that they will take over. So that is the whole process. It's a very system-based, process-based surgery. It's not that anytime I can go to, when someone doctor is doing surgery here and in Burdwan or in remote places, someone will do surgery. No, not that way. That will take some more time to reach out to that level. But yes, of course, it is possible. You will find in social media many of the cases happening, but it's very restricted way as well as of today.
But there is some risk factor is there.
Risk factor to, yes, of course, always risk factor in any surgery. There is a risk factor. Even if you are doing in any of the on-site also, there is a risk factor always there. But yes, of course, that is a specialized surgery, and the patient is unable to move, and that is a life-threatening to the patient. The patient has to go to this surgery. That is the time, maybe that's the taking care. Because one doctor is such a high-value doctor, cannot travel to those places and can do surgery and can come back. Because post-operative care also is very important. So there are surgeons available. They are taking care. The surgery is being done there only, but post-operative, they are taking care.
So another question is that
the lady has been raising her hand.
Just one is related to this one.
Yeah.
We are talking about is the application of the AI, right? But what is the development of the AI? AI is not from this God. So some technology is there to developing this one. Is there any discussions of that? There is no discussions. We are always talking about the application of the AI.
See, in healthcare, as of now, is a lot of research is going on in Google, in Meta, in many places. There is a huge investment is taking place, and particularly in healthcare, Google and all, they are coming up in a big way that they have not yet launched. So that research is going on. Until and unless there is a foolproof system is available, that definitely not going to come up. But how AI is going to support healthcare in a big way in a community can get support, not in any revenue basis or not in any other way. It is purely reaching out to the remote areas, how AI can help support. That is the research is still going on. Little bit of startups already started. They are doing eye cases, identifications, diagnoses, all those things started happening. But more productive AI application yet to come up.
Okay, thank you. So, lady there,
Yes,
keep your question short
yes.
and to the budget, please.
Absolutely. Good afternoon. Thank you for this amazing session, everyone. My question is to, again, Mr. Barua. I run a foundation in 4 countries and we work on women's health and hygiene, primarily on menstrual health. So my question would be how the budget, would have an impact on the PPP model you were, talking about, because we have a target of vaccinating at least 1 million women of HPV. So what model would you suggest us as an NGO? Should we collaborate with the hospitals or we, set up spaces where we vaccinate them as a camp?
See, so far, it's a very important discussion is a PPP because until and unless we come up with a PPP model, healthcare we will not be able to support population the way we have the population. Now, in the budget, that's not much of discussion happened so far. PPP is concerned. For PPP, we need to increase the healthcare expenditure, as I mentioned first, from 1.8% to at least to 2.5%, so that there is a lot of fund is there, so that you can come up with the cancer care, cardiology care. So jointly, PPP more public and private can do. That has not happened this year. Actually, not increased the expenditure until and unless the fund is available. PPP model is not possible. But yes, of course, in Bengal there is a lot of PPP model coming up. This is your cardiac cases. You will find there is a lot of cath lab is coming up. Cancer care is coming up. So some way it is happening, but not in a very big on structured way. But so far your health hygiene is concerned, it's extremely important. You can reach out to any hospital for collaboration. It is not a PPP mode, it's a collaboration actually. So any hospital, there is a lot of CSR activity they have. And definitely many of the hospital will be happy to extend support to you for any kind of this kind of activity, to reach out to the remotest level. Thank you.
Well, I will have to bring this session to a close, but not before thanking my very esteemed panelists on the Mr. Ashok, Adip and Rupak. Thank you very much. We stand very enriched with your views and definitely a very good take on what are the implications of some of the things that have been proposed by the budget. Thank you very much. I think lunch is waiting for all of you. So is that the last, Dwarak? This is the last one. So thank you very much for your patient hearing and hopefully you're taking something out of this session. Thanks.
Thank you. It was a very interesting session. We now have a pleasant task to perform. I request moderator Mr. Rajiv Basu, partner PwC, to please present mementos to the panelists on behalf of the Bengal Chamber. To Mr. Rupak Borua, Managing Director and CEO, Woodlands Multispeciality Hospitals Limited. To Mr. Adipnath Pal Chaudhary, Chairperson, National Shipping and Logistics Committee, the Bengal Chamber, and Managing Director, Bamal Lorry and Company Limited. To Mr. Dharmarajan Ashok, Executive Vice President and Head Corporate Taxation from ITC Limited. And to Mr. Oyon Banerjee, Director Finance, TIL Limited. I request Mr. Subroto De, member of the Managing Committee of the Bengal Chamber and Managing Partner Deyan Bosch, to please be on the dais. I request sir to please present a memento on behalf of the Bengal Chamber to Mr. Rajiv Basu, the moderator. For a group photograph, please I request all the panelists and moderator. Thank you all for joining us today. Please join us for lunch at the Bengal Lounge, 3rd level. Thank you.